Okay, good morning, everyone. We're going to get started, and today is Monday, and we're in week 9. And I want to take a couple minutes to just sort of talk about where we are and where we're going, and what sort of the plan is for the next week or so, and then we'll sort of play it by ear as we get a little bit deeper into the material that we're running into now. So I'm going to just take a look at the syllabus here. I'm just trying to get the camera focused the right way here. And let's take a look on the syllabus itself. So we're in week 9, and one of the things, if you had not caught what I did with regard to chapter 13, which is right here, chapter 13, the original due date, these were sort of boilerplate. They were created by committee, and they're subject to a lot of flexibility. I actually moved it to originally the 20th, the due date for the homework quiz and bonus, to the 20th. I moved it back one additional week just because I thought it's so fundamental of a chapter, so important of a chapter that it would really benefit students to have that additional time. And we finished really talking about the content on chapter 13 on Wednesday. And I think my initial plan had been to do some problems in the back of the chapter, but I did a lot of the math really already. That's really what I'm trying to do with the chapter problems at the end of the chapters, to sort of go over some of the math and some of the trickier aspects. So I think in the interest of time, I'm not going to do that, but what I would point out to you is you still got until this coming Sunday to do that. So one strategy that I would recommend is, if you're not feeling particularly confident about your ability to complete the homework quiz, bonus, etc., you may look at some of the back of the chapter exercises. And if you have questions about those, that's a good opportunity to get with me and say, hey, look, I need help on this or that or whatever, and that's perfectly fine. And I think that's a reasonable strategy in order to do that. And so you've got time to do that. So obviously then we're going to start Appendix F, and I'm adjusting the due date on this to the 3rd. I think that's probably going to be a good due date. We're going to probably get through almost all of this week, really. This particular module, and again, the course is organized in terms of modules, not weeks. And this particular module is about half the length of chapter 13, the CVP analysis. So I think we can easily get through that. So I moved that to November 3rd. I haven't made the adjustment yet in Brightspace, but I will a bit later today when I go in. I usually go in and do some maintenance on Mondays on all these online elements of courses. And I fell down on the job because I did not post an attendance link for weeks 7 and 8. And I am really asking everybody to, if you watch the video, sort of offline and, at a different time, and it's perfectly fine. You just record your attendance by saying, I looked at these videos on whatever days. And I know that it's not a perfect system, but I don't know any other way to record attendance, and we are required to record attendance. So I'll post those, and I'll make them in a prominent place, and just know that we've got those there. We're simply required by the government, because we receive federal financial aid, to record people's attendance. And so that's not something that I'm imposing on everyone. It's something that we're supposed to be doing. So it had been a while since I did an attend anywhere class, so I had sort of forgotten that we had to do that particular link. If you're watching live, we capture your attendance on Zoom. There's no problem there. And if you're here, obviously you can sign, and so you'll be good to go for as far as that goes. Okay. So I just want to take just a real quick look ahead here. So we're going to cover activity-based costing today. There's also a discussion activity which will also be due by the 3rd. So you don't really have to post by this week if you want to take some time, particularly if you're still focusing on the material for chapter 13. We've got one more chapter to do before we get to the next exam. The next exam is coming up in a couple of weeks. That's going to cover chapters 13, 14, and Appendix F. And these are a little bit out of order. It's actually chapters 13, Appendix F, and then chapter 14. I don't know why the text is organized where they do not create a chapter for activity-based costing, but instead have an appendix. But nonetheless, we feel in our department it's important enough to devote a particular module for that, to that particular activity. Okay, so look for those updates, and if you have any questions, I'm available. I'm here pretty much here every day. So not at my toilet every day, but but I'm certainly around. So feel free to reach out on that subject. Okay. So before we get going, anybody have any questions about anything, either on the live or in the on the Zoom link? Okay, well, let's talk a bit about this next segment. So we're going to move ahead here a little bit, and I think that so. This segment is called. It relates to what we call activity-based costing, and it comes back to this idea that I've mentioned a number of times that overhead can be a problematic area of accounting, and we'll talk about why it's problematic. I sort of just I kind of threw it out earlier in the class, the idea that yes, there are issues with regard to overhead costing, and there are different methods by which companies are looking to capture overhead, particularly in terms of trying to build it into product cost itself. And remember, if we go back a couple chapters when we talked about the idea that as a business is creating output, you've got really two sort of parallel flows going on, at least theoretically. You got the physical production of the good itself or the service, and you got the financial capture of the cost of that good. And to the extent that you can capture the cost of the good as it's being produced, you can better determine what it costs to produce that good in the first place. And that determines a lot of things. And we will hopefully close the circle on this but when we get to incremental analysis, because we're going to talk a lot more about revenue. We got into a little bit in the chapter 13 piece, but that's an important topic for us to get to. So we have really 4 different activities to go with today or this week. We'll talk about the difference between traditional costing and activity-based costing, which is sort of a very flexible sort of set of techniques that are used to capture overhead and absorb them into product cost. We'll look at this from the standpoint of a manufacturer, but we will apply it to service industries. We'll probably get there on Wednesday. And then we'll talk about why, and hopefully, I don't know if we'll get here today or not, but we'll talk about the benefits and limitations of activity-based costing. That is, what are the costs, what are the benefits, and why would a company want to use this in the first place? And I really like the way that the authors have sort of laid out this chapter, because I think they take their time in trying to make a case for why it's a useful set of techniques for capturing overhead. So let's get at it. Let's talk about the first. So first of all, when we talk about traditional overhead costing, this is the traditional system where we determine, or at least we estimate, what we think the overhead costs are going to be for the entire accounting period, maybe a year, let's say, right? And again, I think budgeting beyond a year, and the budgeting process is how this is traditionally done. And I think budgeting beyond a year is really complicated and tricky for a lot of businesses. And I never worked in a firm that did it beyond a year. I know there are examples of companies that have very long time horizons and try to, read the tea leaves as to costs and revenues, all these kind of things. But costs are changing so much now; it's very difficult. But in a traditional system, you would say, okay, we expect to incur overhead costs of X dollars, right? And then we would simply apply that to a predetermined overhead rate, right? The predetermined overhead rate to individual products themselves. And we would do it based upon one particular methodology, and labor hours has often been sort of the default standard. So, the predetermined overhead rate is simply we're going to incur $1 million in overhead costs. We're going to produce 200,000 units of output. So therefore, it must be $5 per unit. It must apply to every individual product. And boom, we're done. It's quick and easy. The problem is it's not quite that easy, and it's also not that easy in the sense that most firms don't produce just one product and don't have just one set of inputs. And so that's why if you have multiple inputs and multiple outputs, we need to find a way to apply those overhead costs, even though they're predetermined. We need to be able to find a better way to do it. Direct labor, whether it's cost or hours, neither one. So this is a dollar figure, that's a number, a numerical figure. It's sort of what they refer to as the relevant activity base. It was the default standard for almost every company that was involved in manufacturing for a very long time. And the reason why is very simple. Number one, labor costs are oftentimes a very significant portion of cost. To the extent that variable labor, that is hourly labor, goes up and down with the level of production, it's a relevant activity cost that we could sort of link ourselves onto, and by doing that, then we sort of arrive at a particularly relevant driver. But things get a little bit more complicated as we go. So in this particular case, there's an illustration that's going on here, and this is covered really throughout the this module, and that is we have a company that produces two products, okay, an ab bench and an ab coaster. And I have no idea what a coaster is. I don't know if it's like the rowing machine or what. It doesn't really matter. So each year the company produces 25,000 of the benches and then 5,000 of the coasters. Okay, so you get two different outputs, or two different SKUs, I guess you could say, stock keeping units, with pretty different amounts of quantity. And as we'll see, these are different products altogether. They absorb different kinds of input costs. And one thing that's going to be consistent is each unit in both products requires 1 hour of direct labor. And so if we're producing 25,000 of this and 5,000 of that, we're assuming it's going to be 30,000 labor hours based upon that. And the direct labor cost, this is sort of given in this example. This example is one we're going to be carrying forward here for a bit. It's $12 per hour. And then direct materials, $40 for the ab bench and $30 for the ab coaster. These are some sort of abdominal workout machines, I guess, for people's homes, right? So we've got different costs, right? Not the labor costs so much, but the materials costs are different, and we've got different output levels. And so we're going to be working with some examples here to kind of show how we are working with cost. And so if you take a look here, and by the way, these slides are going to be really difficult to see, I think, on the video. Obviously, for those who are watching it sort of not in real time, but in the YouTube video, you maybe blow it up on your screens. And this is one of the better ones, but there are going to be some really tiny slides, and so I apologize. Obviously, everything is in the book, and there's also a PowerPoint file you can download. But here you've got a little Excel spreadsheet. You've got the costs. You've got two products here. You've got direct materials, which we just talked about, 40 and 30 respectively. Same labor cost because it requires the same unit labor quantity input. And so therefore, direct materials, direct labor, which notice all we've gotten to here are direct costs. So total direct costs are 52 for the bench and 42 for the coaster. Obviously, we have talked about this again and again. We have three categories of cost that we capture in terms of input costs, not just direct materials and direct labor, but also manufacturing overhead. And again, just to sort of refresh our memories as to what overhead is about, overhead really captures two major kinds of costs. And there's those costs which are so indirect as to be very difficult to apply to an individual cost, mostly to an individual product, because they're spread out over so many units of output. Supervisors' salaries, that is production supervisors' salaries, things like security guards, those are difficult to really put onto one particular product, particularly as we're going to see here, if we have multiple outputs. It becomes really hard. That's one element of cost. The other is the costs they're significant. They're not zero, but they're so hard to apply to individual products that it's just impractical to do that. Whether it's things like adhesives and glues and and paint and varnish and cleaning and heat and all those kind of things. Okay, so all right, so that's where we are at this point. But obviously we've got a big missing piece of the picture here, and that's manufacturing overhead. So let's talk about what's going on. First of all, we have to give some data here as to sales, and we haven't been given that yet. So Atlas expects to incur annual overhead costs of $900,000. Now, where did that $900,000 come from? Well, in this example, it's given, but in real life, where would it come from? It would come from some sort of predetermined estimate based upon probably past experience and incorporating a little bit of future change. I think that's oftentimes the way the budgeting process works. A lot of times, things don't change much from year to year, but over long time periods they do. But recognizing that because there's change going on, you may make a bit of a tweak to that number over time. So maybe last year this company incurred $850,000. We don't know, we're not given that, but I think that's probably a reasonable estimate. But that's for the entire operation, okay? The entire Atlas company. And what we haven't gotten yet, we need to include in the calculation is the ad bench sells for $200 a piece, and the ad coaster for $170. So these are different products that are being sold, and because it's a manufacturer, the buyer here is presumably a wholesaler, a retailer, or something like that. I know a lot of companies have direct to consumer operations these days, particularly with online, but we don't really care about the marketing channel. All we know is we've got these sales. And so we have sales, we have cost of goods sold, direct materials, direct labor, manufacturing overhead, and that gives us total product cost and then gross profit. And I want to make sure that I don't jump too far ahead here, and I just kind of want to do these numbers real fast in chapter 7, just that, because I think that this is one area where it's kind of like we kind of threw out some numbers, and so it's like, okay, let's go from here. And I think we just kind of need to maybe catch our breath a little bit here and talk about where some of these numbers come from. So let's kind of break out the revenue picture here. And I'm not going to do an actual income statement. I'm just going to do sort of a breakout. So let's talk about sales. And sales or revenue is always the same as price times quantity, right? So in this case, you've got what do you have here? You have the ad bench, which sells for $200 a piece. That's the P. $200 times the quantity, which is 25,000 units. Okay. So as a result of that, $200 times 25,000 is going to give us a revenue figure for this one product of $5 million. Okay. The other product is the ab coaster, whatever that is, and that sells for $170, and they sell many fewer units, 5,000 of those, and that gives us revenue of $850,000. So together we have total revenue for both products of $5,850,000. Okay. And I think it was sort of a missing piece there in this presentation. The textbook, the language of the text may be a little clearer, but I just want to make sure we don't get too far afield of where these numbers came from. Okay. And because the income statement itself is done usually after the fact. In this case, what we're trying to do is to be a little bit more proactive here. So those are the sales figures. Let's talk about direct materials. And in this case, we've got the ad bench, and we're given the information in it, but I just kind of want to get to how we got there. And we said the direct materials are $40 for this product. And for the ab coaster, it was $30. Okay. So 40 and 30, and so in this case, 25,000 units for the ab bench, which gives us a cost here of $1 million for direct cost of materials, direct materials for that particular product. And here we had 5,000 units, so we had total cost there of 150,000. So direct materials costs are 1,150,000. That's just the direct materials piece. Okay. And let's do direct labor, since that was also given. Direct labor, and again, I think direct labor is one of the easier pieces of the puzzle here usually, because direct labor is not that difficult to account for, and we've talked about ways in order to do that. So you get the bench here, and remember, it takes 1 hour to produce each individual product, and each labor hour is $12. Okay. Now that, by the way, is maybe a bold assumption that every labor hour is going to be the same dollar figure. But let's not confuse the issue here with that. I just want you to kind of know that it's maybe a bit of an unrealistic assumption. So the labor costs to make the bench are $300,000, okay, for this accounting period. And for the coaster, it's going to be say $12, okay, 1 unit at 1 labor hour per unit. So 12 times 5,000 units is going to be 60,000. So direct labor costs are going to be 360,000. Okay. And obviously we've got one more unit of cost, and that's manufacturing overhead. And for right now, it's given at 900,000, okay? And the question is, and this is where we're sort of going here, is how does that 900,000 get split up between the app bench and the app coaster? And that's really sort of where we're going here. So these are the costs. So this is revenue, it's a sales figure. And we've got little costs, which we'll put little negative signs around. And those are the direct costs at this point. And if we were doing a sort of a mini income statement, we'd have manufacturing overhead, which is 900,000 negative. Okay, because it's cost. Okay, so anyway, that's sort of what's going on there. I thought it was kind of important here to sort of break that out a little bit, because as I was looking it over, I thought that it's a little bit unusual to start seeing an income statement as we're looking to sort of bring costs forward in the first place. But nonetheless, we know what these values are, so they're given to us. And if you go back here and take a look, this is just exactly what I did a second ago. What you've got, and it's really a fairly full income statement. The only part that's missing would be any kind of non-operating items. But again, we're not teaching GAAP accounting here in this course. 5,850,000, which we derived above. We had direct materials 1,150,000, direct labor 360, overhead 900,000. Together, those are the costs of goods, cost of goods sold. Okay, and obviously this is the gross profit. This is gross profit. And right now we're not really worried about these costs here, but it kind of tells you what we're looking at in terms of the sort of broader picture. Okay. All right. Any questions so far before we get going a little bit deeper into this particular company and we start to apply some different costing methods, because this is the issue here. And by the way, this is not often an insignificant dollar figure. I think sometimes people get the idea that when you think of overhead, you think of incidental costs, things which are maybe sort of ticky-tack costs, but they're not really. In fact, they can be pretty extensive in terms of their costs themselves. And so these are oftentimes not minor costs at all. So I think it's important for us to sort of be aware of that. So, okay. All right. So let's kind of move on here, and if there are no questions, and talk about what we're going to do with the overhead. Okay. So remember, under the traditional costing system, we haven't gone to activity-based costing yet. We would simply take $900,000, which is the dollar figure of manufacturing overhead. We think we're going to do divided by 30,000 units. That's 25,000 for this, 35,000 for that, and so it's going to be $30 per unit. Now all we're doing is we're simply just spreading it out willy-nilly and applying them to both costs themselves. And to this point, that's really all that we've done. And if you add these costs, now we have all the product costs, right? Direct materials, direct labor, and overhead, and we have $82 as the cost of production for the bench per unit, and $72 for the coaster. Okay, and that's essentially what is going on with regards to the traditional method of costing. Okay. All right. Well, there are some problems with that, and again, I really like the way that the textbook kind of goes at I think a pretty good pace here at explaining why there should be something different and why there's a new approach needed. And by the way, when we talk about activity-based costing as one of those methods by which we spread out manufacturing overhead over multiple products, there are all kinds of different variations and twists on this particular theme. And sometimes you don't even know if a company is using those, because remember, this is using whatever kind of fashion they're doing, because this is internal accounting. And unless a company discloses what method they use to absorb overhead into product costs, you probably won't know. It'll probably never become apparent what method they're using. And because it's not something that is usually even disclosed in the notes. They might mention it, but it's sort of a lack of detail. But we know that there are problems in the one-size-fits-all approach with traditional costing. And one of the reasons why is we've got a significant increase in total overhead costs. And overhead costs are not small at all. And one of the reasons why is as the economy's gotten bigger, we're talking and we're producing more complex products, it becomes really difficult to sort of absorb, particularly indirect costs into product cost itself. And there are all kinds of little bitty pieces and components, some of which are made all over the place and which are really kind of difficult to apply. Little screws and little wires and circuits and pieces of plastic. I mean, it's just a tremendous number of components that goes into some of the very complicated products that are made today. And I think most of us now have an appreciation for the complexity of supply chains. That's one thing. If COVID did anything good at all, it may have opened people's eyes to how complicated supply chains really can be. So it becomes difficult, though, to sort of take those costs and apply them to every individual product. So in this case, ABC costing is really a response to the fact that it's considered inappropriate to use one overhead rate. And by the way, based upon direct labor, particularly when, and this is important, a lack of correlation exists. And we'll talk about what we mean by correlation and why, when we're trying to determine some other method, as opposed to this traditional method, why some other methods are more valuable. And think about this too. Think about the fastest growing areas in our economy right now. High tech is the fastest growing area of the economy. Labor is an important piece of it, but there are so many expensive materials. Think about the biotech industry and the expensive materials that are being used and the expensive equipment. And the equipment has got multiple uses across different product lines, in different departments, and moves around, and it's got different different uses and whatnot. You can see that labor may not be that appropriate of a driver. Now, when we get to talking about the service industry, I think labor is a very definite, useful thing to hang our hat on. And that's more or less the traditional method, which I think is one reason why service industries are growing much faster than manufacturing industries for a lot of different reasons, but direct labor is certainly the highest cost. And then one final thing here is the idea of complex manufacturing. And I pulled up here, if I can bring it over. I'm just going to want to show you some things here about this idea of automation. And if you want this website, I can give it to you. But if we talk about automation itself, so we're talking about not labor inputs, but machine inputs. And you've got sort of you got a bar chart here, and notice this. And it goes from 2020, and it's got a projection beyond this year. And it's just almost a nice smooth curve. And a growth rate, which this is combined annual growth rate of 10% per year. And it's just because, and they've broken down things like robots and valves and sensors and others. And I do not pretend to be an engineer or a manufacturing person, so I can't really tell you exactly what's going on. The point I want to make here with this is the idea of tremendous growth in inputs which are not human related. And these are expensive materials, and the costs go up and up and up. And we demand it as consumers. We demand more and more complex inputs all the time. And because we demand complex inputs, we end up getting very expensive products. Or we demand expensive outputs. We also get very expensive products. Okay, and then this is a slide. It's maybe a little easier to see. This just has to do with robotics. And I don't know what happened in 2009. I guess that was a recession year, right? It was probably during the Great Recession where a lot of capital spending went down. That's the only thing that account for that. But otherwise, it's a pretty nice trajectory. In fact, it's going up. It is in 2018, so it's not a perfectly up-to-date graph. But when we talk about robotics in manufacturing, it's a huge bit of input today. And there are some industries which are essentially doing away with labor, not doing away with it, but have been replacing labor with robotics. And this idea of replacing labor with machines is not a new thing. It's been going on since the beginning of industrialization, but it's coming on with a vengeance, particularly, and I think of the automotive industry as being sort of the case in point here. A lot of jobs that were lost, particularly during this last financial meltdown in 2009, 2008, 2009. A lot of those jobs are gone. They're never coming back. They've been replaced by robotics. Robots can weld. They can paint. They can move things around. They can do a lot of different things, and it's only going to become more advanced as we get going. Okay, but all this is the only point I really want to make here is the idea to try to impress upon everyone the fact that inputs are more complicated, and they involve other kind of inputs than labor. And so as a result, there's the method that is an alternative to the traditional overhead costing methods called activity-based costing. And so let's talk about what this is. It's got a nice little snappy little acronym ABC. But what it does is it allocates overhead to activities, and those activities themselves are grouped together. And just as we are tracking the activity of goods and services as they're being produced, we're also tracking the costs that are being absorbed, and we're doing those within pools themselves. And accountants like this idea of pools. We use the term pools to capture a lot of different things, particularly things like inventory pools. And for anybody who's an accounting major, you will definitely come and take intermediate accounting. You'll get more involved in things like cost pools and whatnot. And all they are is just simply collections of costs that are segregated, and they're separated from other costs so as not to confuse them. So that the activity pools themselves can be attached to the products. And we do that as we're producing output by the means of what we call a cost driver. And we talked a bit about drivers before. Drivers are simply the things that we hang our hat on, that we latch onto so that we can apply overhead costs to individual products. But we're not necessarily using just direct materials, direct labor and manufacturing overhead. Here we're talking about any kind of activity which is relevant to the product itself. So we're saying here it's any event, action, transaction, work sequence, whatever that produces cost. And what's interesting about this is then there are all kinds of different examples, and I'll give you hopefully a number of different examples here, because I think sometimes when we talk about drivers that and activities themselves and the drivers that are being captured there, I think sometimes it's a better way to view it in terms of example, so you kind of know what's going on. So the pool itself is essentially a cost that's attributed to whatever the activity is. Okay, so what are these activities? It could be anything. It could be machine setups. It could even be things like moving one pallet from here to there, moving goods from one place to another. It could be labor. It could be labor hours. It could be labor dollars. It could be things like by shift. It could be a lot of things. So the cost driver itself is any activity that has a direct cause and effect. Now remember, I talked a second ago about this idea of correlation. There's got to be some relationship between the activity and the cost, and they've got to be in a fairly close correlation. If they're not, then all we're doing is just doing a math problem that has no particular relevance whatsoever. So it's got to have some sort of direct cause and effect. That is, if we're setting up new machinery, it means our new work setup. It means we're getting ready to do a new production run, right? If it's something like machine hours, that's another one that's a big one. That's important. If it's orders, inventory orders, that could be a driver. So a lot of different things are potentially involved in this particular idea here. Okay, and so there's a 4-step process, and I know this is obviously in your book itself, but I do want to talk about the fact that this is a very logical process, and so we're going to sort of ease our way into this a little bit and talk about how we attach overhead, which is this giant figure, to individual cost pools, and where the pools come from. And the pools are a reflection of they're some of the financial reflection of whatever the activity is. And it's got to be an activity that's measurable. It's got to be identifiable. It can't be something nebulous. It's got to be something directly related to what the activity is itself. So the first step here is first of all, to define what the activities are in the first place. Whatever it is that we're doing in business, we have to understand what they are and define those activities. Okay, and then once we define the activities, we can assign cost pools that will capture those costs to be able to attach them to products themselves. And then within those pools, we have to identify what is the driver. In other words, what is the actual thing that we're measuring? That's what really a driver is. The driver is something we're actually measuring, and we're doing something with that particular number. And again, it has to have a strong correlation to whatever the costs that are being captured within the pool itself. Okay. And by the way, this is an interesting point here about estimating total annual cost driver usage. One of the things that accountants will do, and it's a frequent activity, is at the end of some accounting period, once all the work has been done, they prepare financial statements and whatnot, some will go back and say, okay, how right or how wrong were we on some of these costs? And they'll determine variances. And you're obviously not going to probably get to the actual dollar cost. If you do, I'd be shocked. Usually somebody fudging numbers when you get there, because you're going to have an overage, you're going to be over or under on all these categories. The big question is, how much over or under are you going to be? And that informs what your estimates are going to be in the first place. So sometimes looking after the fact and doing a post-mortem analysis, sort of, so to speak, will allow us to determine whether or not our cost assumptions are right in the first place. Okay, so all right, so we've identified the driver, and then we want to compute the predetermined overhead rate for each particular cost pool, each cost pool. And then we're going to take that rate and we're going to assign the overhead as those products are being produced, based upon the predetermined overhead rate and based upon the pools that are relevant to the particular activity itself. And this is, and the next slide here is one that it's just impossible. I mean, I'm standing right here and I can barely see it. But just to kind of you can look at your book if you want to get a better picture of this. I tried blowing this up when I was sort of preparing for class. I thought this is just awful, but you've got total overhead costs, okay? And whatever they are, they're sort of estimated. And you've got these particular steps, and we're trying to determine what the cost pools are. And the cost pools, which are these guys here, are based upon activities. So here, whatever is going on, we're defining activities as raw material storage. That might be one activity. Machining of items or factory supervising. All of these may be relevant activities that we want to latch onto, that we identify as being relevant to the particular job that we're doing, okay? And we want to estimate, so if it's raw material storage, right? And by the way, it doesn't even have to be raw materials. I think one particular driver of companies like wholesalers and trucking companies and whatnot is, and companies that store things, or even retailers probably, is the amount of square footage. Square footage is very often used as a cost driver for wholesale in particular, but I think also for retail in some cases. And by the way, I think your text even mentions the fact that some companies have so many different outputs that they may have hundreds of different activity pools and maybe even more. And again, we probably wouldn't know unless the companies themselves described it. So if the storage is one, then we might say, okay, the amount of square footage would be the driver we want to look at. If it's machining, number of machine hours, that would make sense, right? How often the machine is being used. It's probably variable. And because of that, a lot of overhead does tend to be variable. It goes up and down with the level of production. So that would be a relevant one. If it's mostly a labor-intensive operation, then number of employees could be the particular driver there. And so once we do that, we compute what the rate is. It's basically whatever the costs are that we assign these activities. And using these particular drivers, division probably gives us cost per square foot, cost per machine hour, cost per employee. Now this step here is relevant in the sense that these are, again, and it goes back to this idea of what are the criteria for determining an activity in the first place. It's got to be relevant to whatever it is we're doing. So if it's relevant to the activity that we're doing, then we should be able to measure that activity driver, and because we're assigning a dollar figure to that activity, we can drop it on to the product cost itself. So cost per square foot, cost per machine hour, cost per employee, and all those can attach. Notice cost per employee can apply to multiple products themselves. And so this is where it gets a little bit tricky in the sense that we have to assign pools relevant to particular outputs, okay, sometimes. And so this is essentially the background by which we are trying to get at an alternative method of capturing overhead beyond simply taking the total dollar overhead that we expect divided by the number of products and say, boom, it's there. Why do we care about this? And why is this important? Well, first of all, it helps us to get a better idea of product cost. And that's really, at the end of the day, the major objective. And also, to some extent, it can provide guidance as to maybe pricing of the product itself, particularly if there's some pricing flexibility, which not all companies have, but it might provide guidance there. Or, as we'll see, particularly as we get into the next module in this class, whether or not we even want to do as much of this one particular product as we're doing. Maybe we want to do more, maybe we want to do less, maybe we don't want to do any of a particular product. Simply because once we absorb overhead into the picture, it doesn't make sense to even do it. Okay, so those are things that are kind of where we're going to go. So this next segment is we're going to talk about activity-based costing, specifically to a manufacturing operation, which we've already sort of gotten into. And again, these are the 4 steps, and which we talked about. So I'm not going to spend a lot of time going back over this, other than the fact that we are finding whatever the activity is, find out what the overhead makes sense to be applied. We establish cost pools. We find out what makes those cost pools create cost, and that's some kind of driver, whatever it is, machine hours, machine setups, inventory moves, whatever the case may be, shipments. I mean, there's probably a practically unlimited number of examples that one could use here. And then we're going to compute the overhead rate based upon the pools themselves, and then we're going to drop those on to individual products, okay? And just to kind of give you an example, I wanted to, I know I gave you some examples here. Some of these came from the text, and there are some other driver examples as well. And I pulled this up from the Corporate Finance Institute, which it's a nonprofit that does a lot of research for corporate managers and whatnot. So, and they talk about cost drivers themselves, and these are just some examples that they've given here. And this, I'm sure I can find a bunch of other different examples. So things like wages, which would be labor dollars, labor hours. Those are, by the way, the default drivers, and those activities are fairly easy to measure. Things like machine hours, things like reworks, if we have to reset things up again, that would be an example of particular cost drivers themselves. And things like change orders and whatnot. And so I think it's important for us to realize that there are a bunch of different examples. Your text does get into a number of them. And I think it's important for us to realize that there are different ways by which we can get to these costs. And then we'll talk about this idea of what we're doing with our example of the Atlas company, okay? So before we do that, are any questions before we get back to our ab bench and ab coaster? Let me make sure I can see the room here in case anybody's in. I don't think there's anything in the chat box, but okay, if you do have questions, just let you know. So, okay, well, so we'll go back to our company that does the benches and the coasters, and so this company now is deciding to take this 900,000, and they want to set up some cost pools based upon activities, and so. In other words, there's an assessment done by management that says, these are the things that we have to do in order for us to make these 2 products. We have to manufacture them. We have to do machine setups. We have to order stuff, and we have to maintain the factory, okay? I don't know if these are the most logical examples, but it doesn't really make any difference. We call them A, B, C, D pool, whatever you want to say. And management's estimated that we've got different cost breakdowns for these 4 pools, all of which sum up to the total of 900,000. Okay, so that's the example of the establishment, in this case, of 4 pools. Okay, so where do we go from here? All right, so let's just take a look here and we'll kind of walk through it. And I'll probably get through a lot of what we're doing in this chapter today, but I'll probably, I kind of have an idea where a good stopping point is, and we'll pick it up on Wednesday. We'll do some example problems just to let you have questions about what it is we're doing. Okay, so identification of cost driver. So again, we talked about this idea that it's got to be some sort of activity that's measurable. It's got to be relevant to the activity, to the business activity we're doing itself, and there must be a high correlation between the costs and the cost drivers. And if there isn't, then what we're doing, we're misapplying overhead, and we can misapply overhead even using activity-based costing if we're not careful about identifying the activities themselves. We have to understand what the activity is in order to understand the cost pool. And once we have the cost pool identified, we have to have those things which we can measure that go into it, and then we can sort of apply these as these activities are incurred. 50,000 machine hours, 2,000 setups, purchase orders, square feet, whatever the case might be. Okay, so again, these are the pools for this particular company's activities that they are doing. Okay, so here's what we've got. All we're doing here is transferring this information here, 50,000 machine hours, 2,000 setups, yada yada, over here. And remember, we're going to go back to the estimated overhead. These are the dollar figures for the activity level based upon the pools which were identified. The pools are simply dollars that capture activities themselves. And then we've got this amount of activity usage itself. So as a result, what do we have here on this Excel spreadsheet? So we got these four activities, these four activity pools. We had 700,000 assigned to this one here. Let's just take the first one here. Manufacturing operations. We estimated 700,000 overhead would be assigned and relevant to that activity. And how do we know what the activity is? We know that we can measure it in machine hours, and we feel like 50,000 machine hours is going to be relevant. So 700,000 divided by 50,000 machine hours means $14 per machine hour. Okay, goes into the manufacturing of any products. And again, think about this. Remember, these are indirect costs. This could be for any product that's being made. And the same goes to the machine setups that we've allocated $100,000 to that activity, 2,000 setups. So 100,000 divided by 2,000 is 50. I'll get out of your way here. And all the way across. Again, they've got a sum to $900,000. But what do we do with this? Now, these are the predetermined overhead rates, plural. Not just one predetermined overhead rate that we had when we first started talking about manufacturing overhead. Now we've got multiple rates that we can apply based upon whatever the usage of inputs is. Okay. So let's go and talk about what's going on here. All right. So back to our two products. Let's go back to the outputs here. These are the pools. That is based upon the activities. These are the drivers. This is the estimated use of the drivers. And now we're going to link inputs and outputs together. So remember, we were going to the app bench itself was going to incur 30,000 units of manufacturing time, I guess. And we had different machine setups. 500 for the ad bench, 1,500 for the ad coaster. This is interesting too, because remember, there are many fewer units being produced. Only about 20% of this was being produced in that. And yet we've got all these different machine setups. To me, that sort of is a signal of something. And maybe we don't quite know what that is, but you've got many more setups. You've also got a lot more ordering going on. So you've got a product where you're incurring lots of overhead on a product that we produce much less. And by the way, we have a lesser selling price. And we also use more square footage. So that's kind of it's kind of like a spooky movie where you have sort of a hint that something is about to happen. And so, all right. So any questions about that before we move on to the next issue here? All right, well, let's put those on back to our spreadsheet here. And again, accountants love Excel spreadsheets. And so all these things were given earlier in in the example here where we got these 4 different pools based upon 4 different activities that are considered to be relevant to whatever it is that we're doing here. We've got these units that are broken out, and we've got the activity-based rates that were there. And again, we got those from the earlier calculations that were done. And so what we can do then is say, okay, if we're going to use 30,000, and it could be manufacturing hours or whatever it is, however they're calling a unit, a driver unit, times $14 is $420 that goes to that particular is assigned on that product. And then we've got machine setups, same way, 25,000, purchase ordering 15,000, and 20,000 there. Okay. And that's just for the bench. And so what do we end up with here? We have total overhead costs of 480,000 based upon this. Remember, step 1, step 2, step 3, step 4, right? Okay. We've identified the pools, we've identified the drivers themselves, and we've estimated how much usage we expect to get. We've estimated the predetermined overhead rate, not one rate, but all rates across all products. And so in this case, we incurred 480,000 of overhead, and we produced output of 25,000 units. That goes all the way back to the very beginning. So 480 by 25,000 is $19.20 per unit of manufacturing overhead captured within the ab bench itself. Okay. And frankly, one reason why, and look, it's going to be a lot less than the ab coaster, which is $84. And I suspect one reason for that is that in the case of the ab bench, where there's more output being produced, we're absorbing more cost over many more units, and so it drives the unit cost down. That portion of unit cost, it goes back to this idea of what we refer to as scale. The bigger an organization gets, the more they can spread out costs, all costs over more units. And because this is a much more, a much higher level of production, 25,000 as opposed to 5,000 there, they can absorb a lot more cost into that. By the way, if you take the same calculation here, and by the way, you have lots more cost per unit assigned, mostly because you're not producing that many units. And so as a result, you end up with a manufacturing cost per unit of $84, quite a lot higher than the $19.20 in the other product itself. So maybe this suggests you can maybe try to produce more. Maybe, if you produce less, it's only probably going to get worse. You're going to sort of slide up the curve in this case. So this just kind of gives you a better sort of indication of what the unit cost, at least from the standpoint of manufacturing overhead, comes out to be. Okay. So any questions about how we arrived at this particular number or particular numbers? And again, when you're looking at these, I think what you have to do is take your time in reading it, and I don't see how you can really get a good grasp of this information without reading the text. And know that you're going to have to be flipping around to different dollar figures. So where do we get where do we get 700,000? And we came from there, right? So that's 700,000 for us to apply there. Where did that come from? Well, and if it's based upon the manufacturing, then we're going to divide it up between 420 to one product and 280 to another product, right? And where do these unit drivers come from? Well, we got to that as well. So keep in mind that flipping back and forth, referencing different things is simply part of the process. Okay. All right, and then one final bit here is with regard to this is a comparison of overhead per unit based upon the traditional method versus that of the activity-based costing method. So in this case, if we use the traditional costing method, we would have $30 per unit for each product. And where did that come from? Well, we simply said that we had $900,000 that were incurred, that were planned to be incurred in 30,000 units, right? Among both products, we're simply lumping both products together without regard to the different activity drivers themselves. The fact is we do a lot more work to make a coaster than we do an ab bench, so it's incurring a lot more costs. So if this method here is just going to give us $30 per unit. That's manufacturing overhead per unit, okay? And that 30,000 is 25,000 for the ab bench and 5,000 for the ab coaster. In this case, though, look, when we get to activity-based costing methods, we had, oops, what did I just do here? Let me go back here. I think I hit the end button, so I went off. Sorry about that, went all the way there. Didn't mean to go there. Didn't mean to go that far. Oh, here we go. All right, so sorry about that. So instead of $30, we had $19.20. Instead of $30, we had $84. So notice the variance here that in this case, if we were using $30 and you add up all these product costs together, $40 for direct materials per unit, $12 of labor, that's constant among both products. And overhead was 30, you're gonna have 82 versus 71.20. So you've overstated it by $10.80 per unit for the ab bench. But we've got a massive understatement over here, $54 per unit, based upon one method versus the other. So it's important for us to understand what it is that we're doing and what are the input activities, which is why it's called activity-based costing. What are the input activities that are creating these costs in the first place? And we're assuming that any kind of thing that you do anywhere in business is going to incur some kind of cost. There's almost nothing that involves no cost whatsoever. And so we're saying whatever it is that we're doing, we'll track that, assuming that that activity correlates to the actual production of the good, so that when we create the pool for that activity, it's going to reflect ups and downs of production, and it's going to be in more or less lockstep with the activity itself. So that once the pools are there, we can simply take those pools assigned per unit, right? And divide it by the actual number of units, right? So 480,000 is the cost assigned, and that's the aggregate of the pools, right? 420, 25, you got all 480, that's all four pools together. These are the dollar figures in the pools. And just think of pools as being big, just accounts, and we're segregating, right? Kind of like you might have a piggy bank, and you might put a piggy bank here, you might put money in your mattress, right? Those are pools, right? And that's really what's going on here. It's only their costs, not savings, and so together they've got to equal 900,000 if our estimate is correct. And then dividing by the output level gives us the unit cost, at least from the standpoint of manufacturing overhead. Okay. But notice here that, and I really like this particular comparison because it captures all costs. And notice that we've got overstatement and understatement. And I don't know, $10.80, that might be, depending upon the activity level itself, that might be a big variance that would cause concern. Even for a product that sells for $200, right? But I can tell you that $54, and we're understating and we're underestimating on a product that sells for $170, that's the percentage variance here is big. And I think this is a pretty stark example of why trying to match overhead with those things which are driving overhead in the first place makes a lot of sense. And this is why companies employ activity-based costing. And it can be used in service industries as well. We're going to get to that more on Wednesday, but I think the approach that makes the most sense that we talk a lot about here is from a manufacturing context. And again, I have talked about this idea before, that I know that a lot of students have asked before, why so much emphasis on manufacturing when we're not really a big manufacturing part of the country, and we're not, maybe none of our students will go on to work in manufacturing. And I think one of the answers is that, number one, a lot of the concepts that apply to manufacturing can be applied also to service industries as well. Okay. And I wouldn't foreclose the possibility of working in manufacturing if I were anyone in the classroom, because it could happen. And particularly if they're the areas that are growing the fastest, technology, biotechnology, networking, software, all these have some fairly complicated inputs. And because they have complicated inputs, the assignment of indirect costs just for materials alone is necessary to be allocated in a logical sort of manner. Okay. All right. I think I'm gonna just do a little bit more. I may end up a couple minutes early. But I sort of want to put a bit of a wrap up on this, and then we'll do some when we come back on Wednesday, I'll do some examples relating to the service industry. We'll talk about that, and I'll do some back of the chapter problems and exercises that should be a good preview of what you're likely to see in the chapter 13 activities. And don't forget about the discussion activity itself. We've got this week and next in order to do that, and it is available now. Okay, so what are the benefits? And some of these I've sort of talked about intermittently. Number one, employs more cost pools than simply one, right? And if you're on one cost pool is not really a pool at all, it's just simply taking predetermined total overhead divided by output equals predetermined overhead rate. Okay, here you're trying to assign it a little bit more accurately to each individual output. And by the way, again, I like the example in the text because it sort of illustrates the fact that businesses don't usually make just one product. And as we'll see, even in service industries, a lot of service industries don't just do one thing. They might do a lot of different things. And to the extent that we can capture cost better, it allows us to understand what we're doing, why we're doing it, and how much we want to do of one thing. So that's the big one. More accurate product costing, better control over overhead costs, because we kind of know where the overhead costs are going. And if we're essentially we're incurring a lot of cost in an activity that's not particularly profitable, then we may want to rethink whether or not we want to do that particular activity itself. By activity, I mean the output itself. Keep in mind that in the business world, one of the big thinkers is a guy named Peter Drucker, who talked many years ago about the fact that sometimes there are things you're doing that are just not profitable. Even if you're making a product, maybe you start with raw material and you're making a product, but you get to an intermediate stage and you find, we don't do this as well as somebody else. Ship it to the other person, let them do it. They can even ship it back so you can finish the processing. The idea is that if somebody else can do things better, cheaper, and faster than somebody else, that is the more efficient way to do it. And that's something that is considered at the time. I think it was considered kind of radical. The idea was that we would take a good from raw material all the way to finished product. But what he was saying is maybe not. Maybe you want to stop producing at some point, and maybe you're done and let somebody else run with it from there. Keep in mind, there are a lot of companies that don't make finished goods you would buy on a shelf. They create a product and stop. They would go on, but they found that they can't control their costs very much as opposed to somebody else. And a lot of it has to do, frankly, with size. If another producer can complete the job to produce some final product, let them do it and stop it and cut it off right there. And we're going to come back to that a lot when we get to incremental analysis, which I think is a really interesting chapter. It really tells why accountants are necessary in the business world to do, again, as I've said multiple times, what is. It also supports better decisions, allows us to determine pricing, profitability. I think I sort of alluded to it, kind of gives us an idea of what we're doing and why we're doing it. And instead of using one plywood pool, we have many different cost drivers. We're assigning those based upon products themselves. And notice this is another example. This is, I think, we probably should have had this slide come up a little bit earlier, but we have total overhead costs. And then we have the activities, okay? Drilling, cutting, pressing, assembling, painting, sanding. So, I mean, you get the idea, sewing, all these are different activities. And the extent that we can identify the activities, we can identify what these activities tend to cost us, and then find out, because they're costing us, what drives the cost, the drivers, the countable things that are going on, machine hours, labor hours, amount of material pressed, number of parts assembled, number of parts painted, all the way across. And so we can take one divided by the other, we get a rate per product that we can attach to products. And the only thing we don't have here is the different products that might be involved. Okay. All right, and I think that's a pretty good stopping point. I think that it's kind of where I thought I would sort of end today. And what we're going to do is I'm going to pick up the Atlas Company example on Wednesday. We're a couple minutes early, about 4 minutes early. So does anybody have any questions I can answer before we say goodbye for the day? Okay, well, if you do have questions, feel free to get with me. I'm available, and including if you have questions about the I work for chapter 13. If you have questions about that, feel free to reach out. And otherwise, I will see everybody on Wednesday.